Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence-based holistic insights to help you master the game of building wealth. Okay, in today's episode, I want to talk about property spruikers and property fads because, I've been in this industry in financial services for a very long time, probably longer than I care to consider, but started my business back in 2002. So over the last 23 odd years or so, I've seen a lot of different property trends, a lot of different businesses within property that might be spruiking. Let's call them property spruikers, and they're always going to be there. And so what I wanted to do today is talk about, how do you spot a property trend? How do you spot a property spruiker? And most importantly, how do you avoid it? And look, I define a property spruiker as someone that recommends a property as an investment that is unlikely to deliver the adequate returns, primarily to serve their own financial interests. Now, of course, with everything, there's nuance because in property, most professionals are paid on a commission basis. So there's always going to be some sort of perceived conflict. And when we talk about it a lot in, accounting studies, conflicts of interest, there's perceived conflicts and actual conflicts. So whether there's an actual conflict there, whether it's actually going to conflict the advice is one consideration, but whether it could conflict the advice is the thing that we need to try and avoid to harness as much trust as possible. So I think we've got to acknowledge that the industry works on commission basis, so there is that perceived conflict in place. However, just because someone earns a commission, I know very well that doesn't mean that their advice is going to be coloured by that, because it will really come back to the individual's ethics and morals and what they're connecting with and the type of work that they want to do and whether they want to do work that they're proud of. And any individual that focuses on those factors, or those factors are the most important thing to them, I know in those circumstances, it doesn't matter what incentives you dangle in front of their eyes, they're never going to deviate from that approach. And you can see that when we refer someone to a buyer's agent. Actually, it's not a good example because if we refer someone to a buyer's agent, they're in the position, in fact, it's best for them to buy a property. But I know that the buyer's agents we deal with, if they meet a potential investor and they don't think they should be investing, it's not right for them, they will say no. Similarly, we've run a mortgage broking business for that 23 years. If we come across a client where we think, look, you've got way too much debt, we're not interested in being party to this, we will say no. We think you've got too much debt, we're not going to help you. Even if we could, even if there was a lender that was going to do it, we would be cautious about that. We don't want the blood on our hands, of course. We want to come to work and help people implement smart decisions. We don't want to help them, tie a noose around their neck, of course. So as I said at the beginning, there's always going to be property spruikers. There's always going to be people out there that are willing to advise you to do something that's not going to work out for you, but it's going to work out for them. It is what it is. Let's just work out how to spot them and how to avoid them. Now, let's talk about property fads. Property fads are sort of trends, if you like. And can you make money out of a property trend? Of course you can. 100%. If you buy just before that trend kicks off and you're able to exit before the bubble bursts, then, you can definitely do really well out of a property trend. But of course, you've got to think about the buying and selling costs, stamp duty, transactional costs, capital gains tax. They're all going to eat into your profits. And you've got to leave the casino before you lose all your money. So, the timing to cash out is going to be critical in that approach as well. But look, last week's episode was all about long-term property data and making long-term decisions and the power of compounding capital growth and taking a long-term position in property. And I think that's the best approach. And I think when I say the best approach, we've got to always remind ourselves that there's two components to investing. There's return and risk. And just to focus on return is silly. I just answered a question on YouTube about, the listener proposed that all property performs the same, like outer suburbs perform just as well as inner suburbs. Didn't cite the data, but that was the person's thesis. Even if that was true, and it's not, but even if it was true, the risk is not the same, right? Because if I'm investing in a blue chip suburb where it's well established, there's a long track record, supply and demand fundamentals, the land supply is finite, of course, and there's no more vacant land, the fundamentals are different. So even if it was true, that data was true, there's still the risk profile of those two investments are completely different as well. So yes, you can make money out of property fads or trends, but it's pretty difficult and it's not really an approach that I would consider that you could repeat with the same accuracy and consistency. Now, what I'd like to do is just share a couple, a little bit of a sort of fireside chat, if you like, share a couple of the property trends that I've seen over the last 23 years. And I know I've probably come across like an old man telling you boring stories by doing this, but I think it's really important because there's always been, and I'm only going to touch on a few, there's always been a lot of different trends there's almost always a trend at any particular one time. So I'm going to just touch on a few. But I think it gives you, the benefit of me being able to record these podcasts and write these blogs is that I've got that 23 years of experience. So when I look back over that time, I've got a lot of sort of longitudinal data, if that makes sense, and rather than just, what's going on in the market at the time. So when I started my business back in 2002, yeah, I know that's a long time ago, the property fad at the time was positive cash flow property. So this former accountant called Steve McKnight wrote a best-selling book, and it was called From Zero to 130 Properties in 3.5 years. So it sold over 160,000 copies, which in Australia is pretty extraordinary. I mean, Barefoot Investors sold in the millions, I think, or more than a million. So that's certainly the standout, but 160,000 copies is a very successful business. Anyway, Steve McKnight's premise was simple. Buy cheap properties in small regional towns, typically for between, say, $50,000 and $100,000, that deliver high rental yields enough to cover all costs, including the loan repayments. So that's why they're called positive cash flow. They're not going to put a lot of money in your pocket initially, but at least as long as they covered their full cost. Steve's view was then you've got optionality value because you haven't had to outlay any money and you don't have to outlay money every week or month to hold the property. And then if you just cross your fingers, you hope that you see some capital growth. And theoretically, on paper, you could keep buying more and more property. Now, what happened? Well, Steve McKnight did really, really well out of that strategy, partly because credit was pretty easily available back in 2002. You could have sources of credit where, if he bought a property for, say, $50,000 and it was positive cash flow, and then he got a spurt of capital growth and the property was worth $100,000, all of a sudden his asset and LVR position has completely changed and he could go to alternative sources of lending because at that stage there wasn't the same laws that are in place today around regulated credit and keep borrowing money. Also, because the book was a success, I don't know if Steve started the trend, but there was a trend that regional areas were starting to go through a bit of a boom. So he got the timing right. And but the book would have also, because we talked about the areas he was investing in, so the book would have also, helped in terms of the demand as well. And so it was great for some people, as I said, if you bought a property for 50 grand and it doubled in value or even went to 150,000, tripled in value, whilst you have to buy a lot of these different properties, you've done pretty well. I mean, the challenge is, managing a couple of properties. Anyone's that is an existing property investor, managing a couple of properties can be frustrating at times. I can't imagine what it's like to manage many property, tens of properties. You've got that issue. You've got to think about that as property investors. It's always going to require some time and so forth. Anyway, I had a look back at some of those purchases that sort of fit Steve McKnight's bill back in 2002. And it's hard. I haven't delved into a huge amount of data, but just like for like comparisons, the indicators are that they've underperformed capital cities by about 1.5% to 2% compounding over the last 20 years. So yes, there was a property fad there and people did well. But if they had held on to those properties, they've underperformed. And to be fair, I doubt Steve could have ever imagined the influence and scale of the business that the book would have. And I don't regard Steve as a property spruiker. He's built a business and he was back then building a business around property and property investing. And that source of income would have helped in terms of serviceability and make his strategy work as well. But that was the first sort of property fad that I came across, which is positive cash flow. Given where borrowing capacity is at the moment, where rental yields are and property prices, I don't think we'll ever see the positive cash flow trend anymore. So the next major trend was after the GFC, so 2007, and the idea was buy distressed property in the US. Because after the GFC, or when the GFC happened, property in the US in some places dropped by 30% or more. They had a massive oversupply in some locations. They had a really really loose amount of credit. So people were borrowing well beyond their capacities on the basis that property would always continue to increase. And in fact, the now failed Dixon advisory business, which unfortunately the owners of that business were never held to account, they created a managed fund called the US Masters Residential Property Fund. It's actually now an ETF, URF. Don't invest in it. Steer well clear of it. Anyway, they started that in 2011. So just a little bit after that to sort of capitalize on that trend, and it ended in disaster. So investors lost somewhere between 60 and 90% of their capital. As I said, it was laden with fees and conflicts of interest and related party transactions, all those sorts of things. So it was a quagmire of poor outcomes across the board, but it showed that trend just didn't work. And look, I don't invest in anything I don't understand or know because I don't have to. There's plenty of other investment opportunities, right? So I'm not going to go buy property in other countries because I don't really know how it all works. There's just too many risks, foreign exchange, borrowing, taxation compliance. It gets all messy, and I don't need to. I've got plenty of great investment opportunities here in Australia. So, that was a bit of a red flag. We never obviously got involved. We've seen some clients do that, in terms of come across clients that have done that, and it hasn't worked out. The next one was the mining town boom, and that was early 2010s, I think. And in my book, Investopoly, I mentioned a property in Murrumba in Queensland that sold for $850,000 in 2012. And that would have been off the back of a very strong lease agreement, probably with a mining company employee occupying the house. And in 2016, so 4 years later, the property resold for $300,000. And that was a common trend, right? So the common trend, the idea at the time with the mining boom was, this mining boom is going to last forever. There's a shortage supply of housing. The mining companies have really deep pockets. They'll keep paying for these things. And they were selling on an income yield rather than people considering the value of the underlying land. And obviously, a lot of people lost a lot of money. I've seen also come across investors, in terms of real life, attaching these observations to real life outcomes. I know a few people that were caught up in that and, they lost several hundreds of thousands of dollars. Pretty ordinary situation. And around the same time, there was this push around off-the-plan apartments in Brisbane. So again, this is sort of early 2010s. And there were a lot of spruikers in Melbourne and Sydney selling these apartments to investors for around about $500,000, and they put these information memorandums together that sort of said, this is all the benefits with Brisbane, and we're going to get in, and you're buying a brand new apartment, and maybe there was some rental guarantees, all these sorts of things. But if you spoke to people in Brisbane at the time, they would say, we're not buying this stuff. Like, no locals were buying it. That's always a red flag. Anyway, a couple of years later, you were lucky if you paid $500,000. You were lucky though if they were worth 370. In fact, you couldn't sell them. It was hard to sell them because there was a massive oversupply. Now, 15 years later, those apartments are now probably back to what the people paid. So they've had sort of 15 years of zero growth because they got sold a product. The person pushing that product got a large commission, probably $20,000, $30,000, and then they're left holding the bag. The developer made a great profit, but the investors left holding the bag. So there you go, positive cash flow, US property, mining towns, and off the plan in Brisbane. And around the same time, there was a lot of off the plan property in Melbourne being sold to Chinese buyers or overseas buyers, mainly Chinese buyers. That was pretty ordinary too, and I imagine a lot of people got burnt there. But there's always been these sorts of trends. I just wanted to share, they've been there and they haven't worked out. And you just want to be really careful when you deviate from, something that is sound, logical, and evidence-based, all the sort of stuff that I talk about in the podcast. So as you can imagine, over the years, I've seen lots of them. In fact, and I'm always going to voice my opinion about them. And I'm going to talk about, some of the current ones that I've seen currently going on in the market at the end of today's episode. But, and I'm always going to voice my concerns, right? So keep listening to this podcast, sharing the podcast to anyone that might fall victim to something like this, because I think education is really the best defense. But if I think back, the first article Actually, maybe, no, it was the first article that was published by a national magazine called Australian Property Investor. It's now defunct. There's a website, there's an online version, but it's not the same as the magazine back then. In 2003, I published an article called Unlimited Finance, and I was debunking the positive cash flow investing approach. So, I've always seen these things. I'm always going to talk about them. So anyway, I want to talk about, what are the common sort of trends that I see that these property fads and property spruikers tend to focus on? Well, the first thing is fast money. That's always the hook. They sort of appeal to people that are impatient, that want to make a really quick gain. And unfortunately, delayed gratification is the necessary ingredient to get rich. There's that term, get rich slowly. Really, get rich slowly is really the only way you're going to do it. Howard Schultz wrote a book. He's the founder of Starbucks. Pour Your Heart Into It is the book. One of my favorite quotes from him is that short-term profit never drives long-term value. So it's great from an investing perspective to think about, where can I make money over the next 5 years? That's a short, or 2 years, that's short-term thinking. That's ultimately likely to never deliver long-term value in terms of wealth creation. Therefore, if the sales pitch is all about short-term returns, if that's all they can cite, this is what happened in the last 2 years, and trying to appeal to your FOMO, get in before you miss the boat, all those sorts of things, I'd be really concerned. Anyone that's really focused on helping their clients are going to balance that out and say, yes, we think the returns in the last period, maybe in fact they've been below average. And in fact, that could be the basis or the thesis for investing, because if something's delivered, significant or above average returns for the last 3 years, why do I want to invest now? I would argue cyclically, that's not really going to work in my favor. So I think the people that you can really trust are the ones that talk about long-term returns. And I've seen a few buyer's agents, really good buyer's agents, do that recently, where they're sort of citing, hey, everyone's advertising short-term returns, but look what my client did over the last 15 years. To me, that is more sensible. The next common thing is the business experiences a lot of growth. So what I find is these businesses pop out of nowhere. So they're unknown. They haven't been established for a long time. And then all of a sudden they go from, a small team to a really, really large team. And that really concerns me, because it's really difficult to scale an advice business without compromising on the quality of the advice. Because the biggest constraint is always going to be finding highly experienced, high quality, high moral, high ethical, very ethical people. And so for a business to expand rapidly, I know from my own personal experience, and obviously I know a lot of people in financial services and property industry, to do that, the only way you're really going to do that if you start compromising on quality and or experience. Now, if you start compromising on quality and or experience, then what you must do in order to not maintain quality, but at least not let quality, dip out to worrying levels, is then what you must do is systemize and standardize your approach as much as possible. But then that can lead to generic sort of cookie cutter advice, and you lose the nuance that is always really important in any advice job. So when you see these businesses and they've grown a lot over a very short period of time, you've got to ask yourself, how have they been able to manage that growth? How experienced are the people in there? And if they're not so experienced, am I just going to go through a very cookie cutter approach where they're just ticking checklists and not doing much more than that? And then you've got to really then think about, what is their core competency? What is their core expertise? Is it salesmanship or is it advice? Because arguably maybe the business owners, and good on them, it's not a tall poppy syndrome. If your core competency is to grow a business and to market and do all those things, that's fantastic. But at the end of the day, is the end client, you don't really care about that. What you want is great advice. Similarly, we were talking about sort of buyer's agency businesses, one of the challenges with a buyer's agency business is to deal with volume. How do they deal with volume? Because the reality is that if you're a buyer's agent, I've always spoken about buyer's agents being local area experts, and that's who I'd only pay a local area expert, because I want that local expertise. I don't believe in that borderless investing where buyer's agents can fly into a location and just buy property. So I want a local area expert. I know that if I then if that buyer's agency all of a sudden has 50 clients, how are they going to handle that? There's only two ways. They're going to have a really long waiting list, or they're going to lower the bar in terms of the type of properties they're buying. So that's also a red flag, right? So when you see these property fads, the challenge is always going to be on the implementation implementation side? Are you just another number in terms of a sales pitch, or are they offering really good advice? Next point I want to talk about very quickly is, I talked about fast money is the hook. Well, there's a complete absence of long-term evidence as well. And this is a major problem from my perspective. As an evidence-based investor, I really do want that long-term evidence. Now, momentum and investing with momentum, of course, is an attractive thing. So if I've got a particular, whether it's a share market sector or whether it's a property type or geography that's had a really good run for 2 to 5 years, it kind of feels, safe to invest in that because that market's running. We've already got the more recent evidence, and there's nothing better than buying a property and 12 months after that, I've accumulated a lot of equity. It makes me feel comfortable and happy. There's nothing bad with short-term returns. But the problem is that what I want is really long-term returns. I want long-term compounding returns. And a good analogy is the US stock market at the moment. So over the past decade, just 10 large cap stocks have driven most of the S&P 500's index's return. And by any measure, that market is dangerously overvalued, trading at multiples at similar levels to the tech wreck in 2000s, early 2000s. So while recent returns might excite some investors and tempt them to invest in that market, the reality is that they've probably missed the boat. And the weight of evidence suggests that the returns from the S&P 500 index over the next decade are probably going to be below average. And so the same thing, it's a good analogy to bring to property markets. Do I want to invest in Melbourne that's had, in real terms, no growth for 10 years? Or do I want to invest in Adelaide that's been the top performer over the last 10 years from a median house price perspective? The short-term returns in one, when I say short-term returns, they're 10-year returns, but I still think that's relatively short. Whereas if I go and then think about investing in a regional town or investing in a mining town or investing in positive cash flow, all at the times when those trends were popular, there was an absence of long-term evidence. And so that's always the key from my perspective, because remember, it's return and risk. And if there's strong evidence of past long-term returns, to my mind, that reduces the risk element. And I'm attracted to investments like that. The next thing is to benchmark returns, because are the returns being advertised or suggested unrealistic? And I think this is really critical. Now, over the past 45 years, most share markets and property markets have delivered around 10% on average over very long, over that 45-year period. So, property's typically given us growth between, say, 6.5% to 7.5%, with income yields of, say, 2.5% to 3%. If you look at the Australian share market, it's about 4.5% income and 5.5% growth. If you look at international markets, it's about 2% income or 2 to 2.5 plus 8%. 7.5%, 8% growth. They're the typical long-term returns that have been in place. As I record this podcast, I'm looking at a LinkedIn post from a commercial property buyer's agent promoting an industrial property in a regional New South Wales town, claiming or proposing a return of 12% compounding is possible, made up of 5.5% rental yield and 6.5% growth. Now, whilst that is possible, and I'm sure a return like that can certainly occur for a few years, will that return persist for the next 10, 20, 30 years? Whilst anything's possible, it's doubtful, right? Because what we know is well-established markets are delivering 10% and not more. How can this property, an industrial property, so there's nothing sexy about it, in a regional town in New South Wales, give us a 12% return? Now, what might have happened is they've extrapolated the return over the last 3 or 4 years. Now, industrial land values in Australia over the last 6 or 7 years have either doubled or tripled in some locations. So extrapolating that return is, I think, enticing people to invest in assets that are probably not going to deliver that return. My benchmark is 10%. If you're going to tell me an investment's going to do better than 10%, you're either lying to me or the risk underlying in that investment is very high, which means there's a significant probability that it's going to be a lot different to 10%. Or it could be a great return. But either way, I think benchmarking those returns really then separates the people that are going to be realistic and honest and rational about it versus the ones that are trying to sell a product. The next common trait is a handful of businesses or one book or one podcast or whatever it might be make the market. And we've seen this in Perth over the last couple of years, where a particular buyer's agency that has a lot of buyer demand goes into a location. And I know this because I've spoken to other buyer's agents and real estate agents in that area. They start buying property. And all of a sudden, the real estate agents are thinking, oh, here's some easy sales. All I need to go is find the listings. And they'll go around in their area and say, I've got these investors I want to buy. I reckon I can get you, your house is worth, I don't know, 450, I reckon I can get you 500. And then the buyer's agency business goes back to their clients and says, oh, we bought for 450 and now it's 500. This market's now on the move. And then next time around, the vendor expectation lifts and the agent thinks, we can get more money out of these people because mostly they're interstate buyers. And so the next transaction occurs for 550 and so on. But the only source of demand is this one business. And this business is one cohort of clients. And it's a real problem because if you're at the end of that, if you're at the start of that, it might work out in your favor. But if you're at the end of that or the middle even of that process, you can end up overpaying for an asset. And no, you will end up overpaying for an asset because what you want and what the great thing with property is it tends to be a very transparent and open sales process. So for you to understand what is the market value, you can go to an auction and everyone is there and everyone's bidding against each other and it's very transparent. So if I've got 3 other people willing to pay $1 million for this house, then I can be confident that that's what the market value is. Whereas in these processes, it's far less transparent and there's artificial demand there. So I think the key here is buy in locations where there's just as many owner-occupiers as there are investors from a buying demand perspective, because that's really what you want. The owner-occupiers are the ones that are going to push the property prices forward because they tend to be more emotional and they're buying for other reasons like proximity to schools or family or, livability, all those sorts of things. Investors don't really care about those things. They just focus on the numbers. They're far less emotional. So you do want a really strong component of owner occupiers, and you've got to be careful if you're buying interstate, you've got to be careful to make sure you're buying into a market that is very balanced in terms of demand supply. Okay, and the last thing I want to talk about, and this is going to come across ultra cynical, is these businesses tend to accumulate a lot of 5-star Google reviews. Now, I know it sounds ultra cynical because isn't that a good thing? Of course it is. And, Pro Solution, my business, has a bunch of 5-star Google reviews, but, they've been accumulated over many years rather than just a short period of time. Always makes me skeptical, right? Because if I've used a buyer's agent, for example, and gone and bought a property, how can I give them 5 stars? I'm going to give them 5 stars because I like them, I enjoyed the experience, and I think the property is going to work out well. But really, the saying is, the proof is not in the pudding, it's in the eating. And I haven't eaten the pudding yet because I haven't seen what this property is going to do. So why does this happen? How can they get so many Google reviews so quickly? Well, it could be that they've experienced some short-term growth. Well, that's fantastic. That's fair enough. Maybe the firm has incentivized them to provide a 5-star rating. Maybe there's some sort of incentive, something free. Maybe it's confirmation bias that's in the process because, there's a natural tendency to convince ourselves we've made a smart decision because the reverse is obviously really difficult to live with. So, sometimes we talk ourselves into, well, this is going to be the best investment I made. Bang, there's my 5-star Google review. Anyway, I know it sounds really, really cynical, but it's just interesting that I think, I value the review that I get. Like if I have a client that's really happy after a year, I'm ecstatic, of course. But if my client after 10 or 15 years say, Stuart, this is a fantastic outcome, that's what I'm really enthusiastic about because I know then it's based on results, not expectations of results. Okay, let's talk about some of the current trends that are occurring. So hopefully you can steer clear of them. The first one is that, and it's maybe a trend that's fading out a little bit because I haven't come across it more recently, but there's a trend of buyer's agents selling development sites. And I guess this is off the sales pitch is, short-term property gains, buy a pretty ordinary house on a big parcel of land land, demolish it, build a couple of townhouses, make a huge profit, maybe sell two, keep one, for example. Then you've got a property with a high rental yield and you've cashed out your equity and you're off to the races. But it reminds me of a saying that American billionaire Mark Cuban says. He says, never take advice from someone that doesn't have to live with the consequences. And it's kind of an interesting thing here because this is exactly what's happened is they don't have to live with the consequences of developing the property. And so if I was going to ever do something like that, and I don't think I would, but I want to make sure that the person that's telling me to buy this property has some sort of skin in the game. They're either going to co-own it with me or they're a business that actually going to help me then develop the property, because then it's on them to make sure they deliver the returns. They're the ones that are going to be holding the bag at the end of the day. And so we've seen in our business a lot of people being sold these development opportunities and they're actually just not viable, right? So they've been sold this property, but they haven't understood what to look for and do the due diligence and all those sorts of things before they buy, then overpaid because they think there's an opportunity here, and they're left with a dud property, a shit property that's not actually going to do anything, that they can't develop, and they've got to get rid of it. And we've seen many of those sort of circumstances. So if you are sold that idea, go and get some independent advice in terms of a feasibility study before you go and buy any property under that premise. The next one is, which is a current trend, is commercial property. That is buying commercial property because of higher yields. And almost any commercial property anywhere, it seems, is a good idea. And I can see why it's gained popularity, of course. There's tighter borrowing capacities, so it makes the residential market less affordable, of course. We've seen strong price growth over the last 5 years in both Brisbane, Adelaide and Perth, and also regional areas. And, those markets are no longer cheap and they're more difficult to get involved in. And, commercial tenants cover most of the outgoings. So, you don't have the property expenses along with them. But, buying any property anywhere never makes sense. And following a trend is a really risky thing, as I've said today. So I'm going to write something about this commercial property market trend. I'm still thinking through it. I'm going to do an episode on it, but it's not something that I'm interested at all in at the moment. And it just seems like a property fad to me, which is not to say all commercial property is bad. But as I said earlier, industrial land values in Australia, many locations have doubled, tripled over the last 6 or 7 years. And retail properties, always sort of struggling. Office properties, in the doldrums. The vacancy rates are sort of at recessionary levels. And when you look at the yields these properties have been sold on and compare them to other assets like Tier 2 government bank bonds, where they're sort of paying high 5% for zero risk, relative value just doesn't seem like it's there. So I'm going to do something on that, but that sort of sector of the market doesn't look particularly attractive. Anyway, I've gone way over time, so sorry for prattling on, but I think this is a really important episode because, as I said, property spruikers are always going to be there. There's always someone going to be there that wants to sell you something that for their own benefit, and really education is the best defense. So I really wanted to dig deeper on this today. But the key to building wealth is repeatable success. And I think listen to people that have built wealth over many decades, that have weathered many cycles, that have seen it all, tax changes, rule changes, new products, market fluctuations, all those sorts of things. There's always going to be property spruikers, but it's really about paying attention to the long-term investment fundamentals and evidence-based approach. Okay, I'm going to leave it there. And next Wednesday, Campbell's going to join you. He's got a really interesting episode about land tax. And there's some really interesting data that comes out there, some surprising data because, Victoria's always spoken about in terms of a heavily taxed state, and it is. But what Campbell's going to share might surprise you. Okay, that's it for me today. Until next week, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.